So she is a sole a company shareholder, which she founded nearly 20 years ago. Over
Pre-2002, therefore, no IFA, no intangible fixed asset.
Pardon?
Again, it's not. It's pre-2002.
Oh, it is goodwill will be taxable as a capital gains.
Correct. Yeah.
Okay, this is why we have to be aware about the goodwill. Yes.
Yes. So it's not relevant at all. You read the question.
Good.
Explain how Sally Bonds may share value with a management team on an eventual sale of the company. But
I don't have any clue about this, but I will do my best. Over the 20 years of the company's existence, it has grown significantly. Turnover for the year ended 30th June 2021 has grown to 15 million and gross asset at the same day 3.5 million. The company has 85 full-time employees. So they gave us information just in case to be vigilant that the company will qualify for some share scheme. Yes.
Excellent.
Good. On this condition, because Sally has built up a small but talented management team who look after the day-to-day running of the company's operations. So we're talking about management team. As she's now 60 years of age, Sally is looking to retire from the business within the next 5 years, and it is likely that she will sell the business to the third-party purchaser at the time. So she wants to sell her business to unconnected person. She wants to sell her all shares to unconnected person, to unconnected party, yes?
Exactly. Correct.
Sally regards the management team as being crucial to the ongoing success of the business, and the loss of some of them to competitor companies would have a negative effect on the value of the business. So it looks like she's thinking about for retain of the staff. So she thinks how she will hold the staff. Yes, sir.
All right. So there's 3 reasons why share schemes are used. One is to retain key staff. The other is to motivate staff. And the third is to remunerate staff.
Okay, motivate and remunerate staff. Okay.
Remunerate and retain.
Retain, motivate, and it's very good. I can remember these 3 words. Okay, as a result, Sally wishes to consider any potential tax-efficient ways in which she could incentivize the management team to remain with the company. One option she would like to explore further is how the management team could share in the value of the company on the eventual sale, as they have help to create it. However, this should only be the case if the manager remains with the company at the time of its sale, and so Sally does not want to simply give them share capital at this point. Okay, I believe they wanted us to talk about enterprise management scheme, EMI.
As in, that will be the main talking point, correct? But then you can also explain how she may share value. So there's other ways to share value as well. It doesn't have to just be EMI. EMI is probably the best option, but there's also CSOP. There's just non-tax advantage share options, and you can also potentially just give bonuses as well, cash bonus. So we need to discuss. It's not just the one thing you discuss. You have to explain how she may share value. So EMI is probably the best way, but there's other ways as well. To explain all the ways.
So if I started with EMI to say that this company will qualify for this scheme because it is only 85 employee, 15 million gross asset, whatever, to come with this idea. Also, she's thinking only to reward some special staff as a management staff. So I think I will go through how called at the moment, because it is an open book. I need to go and find that scheme, and I can't find
Yes.
it very quickly. I think it's in the
You
person.
have to spend some time this week familiarizing yourself with the memory joggers. It's important that you find things quickly.
Okay, because you will see if I pick the individuals, I will find very quickly. As a OMB, no, because it is 4 of them. Do you know? Okay, I will doing my best, and I can't find them very quickly.
Maybe you should put them, them little stickers like that come out. So you say CT, CGT, IT.
I already put it, and still, do you know, it's like, because sometimes it's no any logic. Capital allowances, they're not in corporate stuff. They are in the business stuff.
Yeah.
Do you know? Yeah, I found it. Enterprise management intensive scheme. And I will start to talk that this company will qualify for this. And she can grant it a maximum value, that it is for small company design, what she will qualify. Yes. Also, she will say it on the grant, no tax, but they have to exercise this option within 10 years. Yes.
Yep, correct.
So I will go through all these options.
Yeah, so effectively, you started by talking about the conditions being satisfied for the company, so that's good. And then you need to talk about the conditions for the employees. So they must be work 25 hours per week.
Okay.
And the maximum value is 250,000, right?
For employee, yes, 250,
yeah.
yes, thousand. For
and
employee.
Yep.
Okay.
Yep. And then you mentioned the grant of options. So you need to notify HMRC following the issue of the shares, and there'll be no tax on the grant of options. You mentioned that they must exercise within 10 years.
They have to issue not at the discount price, otherwise it would be tax. Yes.
To income tax, exactly. So if the shares were granted at a discount to market value, then the difference or the increase in value will be subject to income tax. And because we're looking at on sale of company, it would qualify as readily convertible assets. Therefore, PAYE and Class 1 NICs will be due for both employee and employer on that exercise. Okay?
Because
on the sale of the business,
yes,
you would treat them as readily convertible assets.
So it would be not EMI.
No, it would be EMI, but it'll just be readily convertible. Therefore, PAYE and NIC.
Because I have to mention that if arrangement in place, it would be a ready convertible asset and also subject to PAYE and national insurance contribution.
Yep, for both company and employee.
So I have to mention if or, because she's thinking to sell this company, and if the arrangement is in place, it would be subject, and the base cost of the shares will be what they paid and plus the amount subject to tax, chargeable to income tax.
Excellent.
And the proceeds,
very good.
And the proceeds will be subject to capital gains, which actually they will save some money because tax at 10 or 20%. Okay. I would.
Yeah. So EMI shares can get business asset disposal. So you only pay capital gains tax on the increase in the value of shares. Okay. And if they've been held for more than 24 months, then you can get 10% business asset disposal relief.
Yes.
You mentioned that as well, and you'll get 1-2 marks there.
What else I can mention? It's all. My question is.
Okay, that's just EMI. As I told you, there's other things that you need to explain as well. So EMI will probably give you about 5 marks, or maybe 6, you probably get more marks with EMI. Let's just say 6 marks for EMI, 1 mark for presentation, so 7 marks.
Oh,
Now the other things. Yep.
They don't have a presentation now, I think.
Sorry?
They will not have a presentation mark, I believe so.
Why?
Because I don't know, I think they now only ask you to explain, know anything how letter or memo. So they
but not presentation, sorry, you're in the higher skills. Skills.
Mama, we can hold the breath here. I'm very safe with these marks. So it's not my. Okay, next.
Okay, next is CSOP, so company share option plan. You'll mention that only 30,000 shares can be issued. So really and truly, there won't be really any benefit.
SOP, okay, when it is only up to 30,000, yes, sir.
Exactly, CSOP, company share option plan.
And it doesn't need to be for all employee, no discount, rewarded shares up to 30,000, and they have to exercise within 3 to 10 years. If they exercise before 3 years, it will be subject to income tax. After to income tax, between 3 to 10, it would be subject to the capital gains tax.
Exactly. So if the conditions are met, there's no income tax, but on the sale of shares, the difference between the proceeds and the amount paid for the shares would be subject to capital gains tax. And yeah, that's fine.
And it
so you get, yeah.
Shall I mention this about ready convertible asset or not?
Well, not really, because you've already sort of mentioned it.
That's all, yes.
Yeah, but you will mention that this scheme, so it's saying explain how Sally bonds may share value. So you're explaining CSOP, but then you can say that this scheme is not very appropriate because only a small number of shares or small value of shares can be issued, and the current value of the company is way larger. So it's not really any benefit. So it says inappropriate.
Okay. So I have to say CSOP is not good because only up to 30,000. They said it's CSOP is for unlisted company.
Yep.
Provided that the company is not controlled by another company. It's all.
Yes, so that's fine. It's possible. Lothian Engineering Limited can
not controlled by other company.
Exactly. The thing that we forgot to mention is yeah, no, that's fine. That's fine, yeah.
What about this share value? Explain how Sally bonds may share value with her.
Yeah, so that's what we're saying. We're saying she can do EMI or she can do CSOP. Now, another way she can share value.
Share value of your company, sorry.
Yeah.
She share your company with other, sorry, my English is like.
No problem.
Share, it's it, share. Share is the shares. Eventually sale of the company. This is, the question is how she will share her company with her before she's going to sell. And this, I will go for EMI, CSOP. Do I need to mention non-tax advantage scheme?
You would, yes. You'll explain non-tax advantage scheme. Yep, so go for it.
Advantage scheme, it's no any tax for, they are available for, not necessary for every employee. And tax advantage scheme, because it is available for any company, for a limited company, will be available.
Correct.
And
Correct.
why it is non-tax advantage, because no tax on the grant of the option, but will be treated as a taxable income and subject to PAYE and national insurance. Shall I say, if the tax will be collected through the PAYE, if it is not enough money there, the company can pay this amount on behalf of employee, and if it is within 90 days, the employee will not repay this money back to the company, it would be subject as a benefit in kind.
Yeah, so all that you'll mention when you're discussing how to share value with the company.
So I can go as many options as I can here, and restriction.
Yeah, because that's what the question is saying. Explain.
Also, I can mention the restriction shares, yes, here, because she can restrict or not.
No, why would she restrict the share?
To hold the staff, retain the staff key.
Yeah, but restricted security is nothing to do with retaining staff. It's not a share scheme.
Ah, okay.
That's something completely different. Restricted shares is it's nothing to do with sharing value. No.
Okay, fine.
You would have mentioned that. The other way she can share value is, so obviously the obvious option to share value would be to give options over shares in the company. Okay. And you can so the advantage of that is the management team that have these shares can you hear me?
Yes.
Yeah, the management team that have these shares would, when the company is sold, they would share in the proceeds. Okay. And they'll be subject to capital gains tax, and with EMI they'll also get business asset disposal relief. The final method that she can share value is just a simple bonus. So she could say that the employees who remain with the company at sale could be paid a cash bonus in line with the increase in value of the company. In 5 years' time, she just tells them now that whoever remains with the company will get this bonus in 5 years' time. Okay? But it's not tax efficient. Why? Please explain.
Because it would be taxes, income tax. Bonuses will be taxed.
Exactly.
And plus,
exactly. You'll have income tax and NICs at 47% totally, potentially. And the company would also pay 13.8% on the amount, but the company would get an allowable deduction for the amount of the bonus and the employer's Class 1 secondary contribution.
Okay.
Now that will give you easy 3 marks.
So the simple, the bonuses, she can pay bonuses, the value of which will be in line with the profit of the company.
Yeah, something like that. Exactly.
Increase,
yeah. But the bonus will be paid in 5 years' time.
At 5 years' time. Okay.
Just before she sells the business, she pays them a bonus. Okay. Any questions there, or shall we move on?
No, it's fine. So it's good.
Okay.
Good question. Thank you.